Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. In this episode, Mark and I are going to go through a live analysis of a real semi-commercial investment opportunity. Property has 3 commercial units on the ground floor, 2 currently let to a building society and 24 student rooms across the upper floors. On the surface, it has several attractive features, diversified income, a recognised commercial tenant and a large number of rooms, but it is also a type of deal where the headline numbers only tell part of the story. We're going to explain how we approach the analysis, what we look for in the income, the tenants and the demand, and what had to be considered before deciding whether the property was genuinely financeable. Let's dive into it. Mark, welcome back to another episode. I'm excited to discuss this one as well. I guess I'm probably excited to discuss everything we talk about, which is, I don't know how genuine that is. No, look, we do enjoy these and kind of just chewing the fat over different things that we've got going on and kind of looking at the pros and cons of different deals and structures and finance and everything else. So yeah, we thought this might be a decent episode. We had good feedback on the case study deal that we did prior. And so on that note, we thought it might be a decent to do another one. So without further ado, do you want to just kind of give us an example or give us the rundown on what the deal that we were looking at is, and some of the numbers and the structure of the deal, etc.?
Yeah, all right, cool. So we are actively seeking opportunities and we've looked at many. To be fair, a lot of them don't pass the make sense check. The very, very high level, quick disregard, move on type approach. This is something that we're looking to spend a bit more time on it. We liked it on face value and then started to, do a deeper dive into the numbers. So just for context, to set the scene, for what we're talking about for the rest of the episode then. This is a building that is a substantial building. We won't disclose the details specifically because there are reasons why we don't want to do that for confidentiality purposes. But in general terms, it's well located. This properties of this nature don't come up very often in the area we were looking. So it grabbed our attention almost immediately. It consists of 24 student-let units and it has commercial on the ground floor. The commercial is occupied by 2 tenants across 3 commercial spaces. And we'll come into that in a second. At a very high level as well around the numbers. So the commercial income gross was around 75,000. And then when you look at the student let income at 100% occupancy, the gross income on that was around 164,500. The vendor was asking 2.5 million for it, offers in the region of 2.5 million. When we spoke to the agent, they were not in a major rush to sell. But, they would obviously listen to the right offer and they wanted it to be as close to the 2.5 as possible. So that's what we're looking at. That's sort of hopefully paints a picture as to the sort of transaction we are. So it's multi-unit blocks. We spoke about these in the past, multiple units in one freehold. Yeah, and that's a bit of a rundown of the property and the opportunity that we had in front of us.
Yeah, so like I said, just to kind of echo the sentiment around, it's a lovely property as well. It's in good condition. It's in a good location. It's got lots of things going for it. But ultimately, then when you start looking at that, you start getting a little bit emotional around, it's a nice building and this, that and the other, which is obviously important. But, ultimately, we want to kind of come back and bring ourselves back within the guardrails of, does this fit our investment criteria? And do the numbers work? And we just go through then the analysis and the due diligence that goes with this type of purchase. And I guess the purpose of this episode is just kind of walking through that and talking through some of the thought process, which we think listeners would would find useful if they're embarking on either a semi-commercial of this nature, or just generally other, maybe there's a little bit more to commercial than there is to residential. And if they're looking to invest in that space, then hopefully there'll be some nuggets in here that they can pick out and use for their own analysis. So outside of the actual building itself, was there anything particularly that jumped out at you from this, as an investment opportunity?
Yeah, so you would like to think that with 24 units residential, that would be a good rental income. And on the face of it, it is. If we just took the simple metric of gross income times or divided by whatever yield you would want to apply to that, then the numbers start to be interesting. Not exactly to where the purchase price or the offers in the region of figure was, but ultimately not a million miles away, so close enough to have a conversation. So it's not as if we were starting at half of what that figure was to start the negotiation. So that was interesting. The building was freehold, which you don't often get. Now, we've had a conversation about this. I don't know how much value that adds to the transaction when you consider how the lease operates on a leasehold basis. So, but it was certainly something that was flagged, that you don't get them freehold very often as well. So that was something else for us to consider. And then I think one of the main elements to this was it had a very strong covenant on the ground floor, in part of it, which was a bit flagship on our part, and just gave us comfort that if they were in situ, then the building as a whole was in a good location, was always going to attract occupancy up above, and that it was going to get looked after as well, given the nature of the tenant involved.
Yeah, so just circling back to the point on the freehold, we would always rather own the freehold, because whenever there's leaseholds, if there are lease issues, then you've got to deal with a number of parties, and especially on a mixed commercial, so you're dealing with a few different parties if it's leasehold, and then getting everyone to agree, and the more parties that are involved, the harder it gets, and who's responsible for what, and if that's not always very clear in leases and things. So yeah, I think that the fact that it was freehold was a big attraction. And then, like you said, just location was good, tenant was good, and then just kind of going through that. So if we just start looking through the stepped process of what we would do from an analysis perspective, we looked at the purchase price. One of the second question, you would say, well, okay, you start looking at, so this is the purchase price, right? What fees am I going to have to pay? And one of those first questions then is stamp duty. And we use the phrase stamp duty as a catch-all, because obviously depending on where you are in the country, whether that's England, Wales, Scotland, Northern Ireland, everyone's got their own version of it and call it something else. And then you've got both your residential stamp duty, but you've also got your commercial stamp duty. And with this being a semi-commercial building, it would fall under commercial stamp duty, and therefore working that out on what that is. So that's the first step. Which is it, residential or is it commercial? Is it stamp duty? And then that asks you that leads you on to the second question now, which is the property owned by a company, or is it owned in a personal name? Because obviously if it's owned in a company, then that leads into another question. Are there any other assets within that company? And are they looking to sell the company, or are they just looking to sell the individual asset? Now, the reason we asked that question is this property could be held in an SPV with no other assets in it, in which case they could sell the company or the asset. And that's a question then that leads us down another path around, okay, well, is there ability for us to purchase the company, the SPV, which means we would pay stamp duty on the value of the shares, not on the value of the asset. So there's a different rate of stamp duty. And even though the value of the company would probably be the same as the value of the asset, you pay a different percentage on stamp duty on shares than you do on property. So it's a slightly different play, but on a purchase of circa 2 million, I think you save around £95,000 in stamp duty, depending on, obviously there are a few different moving parts, but there's a significant saving when you purchase the shares and not the the property.
Yeah, so when you think of the company purchase, so you've got, if you bought the asset at the purchase price 2.5 million, let's just say they've got some debt on it. Most properties got some debt on it, so obviously they would then have to settle the debt and they would get the equity. Effectively, that's how it would work. Say when you buy the company, you would only value the company at the equity value, not at the asset value, because obviously there's debt in that company as well. Therefore, a 2.5 million purchase might actually be a £500,000 purchase, and then you're only paying 0.5% on the share value at 500,000, which significantly reduces the tax liability and the tax burden on that. So yeah, there's a few bits really that make buying companies interesting, albeit they're complex, and that's probably a conversation for a different day, to be fair.
Yeah, so exactly. So we're going through this process, right? What are the fees that we've got to pay? So stamp duty on what? And then obviously one of the other facts that you need to consider when there's a commercial building, is there any VAT considerations? So with VAT, is the property elected for VAT or not? With it being commercial, again, that's probably another episode talking about VAT. So, and you pay the seller, if the seller is elected for VAT, then the seller would pay, you have to pay VAT on top of the purchase price, which obviously brings another layer of complexity. So, and then you're looking at your fees, whether that's broker fees, solicitors fees. Obviously, on a commercial solicitor on a property like this would be a lot more expensive than a conveyancing solicitor on a £150,000 mid-terraced house, So those are the kind of things. So you just looking at your different fee structures, and then obviously we're looking at, are there any capital expenditure that needs to happen immediately in terms of refurb or anything else within it. So early on, we're just looking at what are those sort of acquisition costs, because when we start doing an analysis, and this is what we see quite a bit of, is people will do their numbers, and we see this more in development than in anything else. People will present, well, this is the purchase price and this is the refurb cost, and the refurb cost is part of it. It's the project cost is what we would rather know, because you've got your professional, on a development, you've got all your professional fees, your insurances, on everything that happens outside of the actual refurb. And it's the same with this. So if you just look at the purchase price, and that's it, and you don't consider VAT, you don't consider stamp duty, those can be significant figures, and that should form into your analysis as part of your overall yield, return on investment, whatever it is that, metric that you're using to analyze the deal. So once we've got to that point, we've kind of then worked out, right, these are my all-in figures. And then from there, then you start to kind of work backwards and go, right, what metrics do I want to use now to assess this in terms of, does it make sense for us based on our criteria, and does the deal work? So on to the next step then. So once we've done and analysed the initial purchase price and all of the costs based on that purchase price, what's the kind of next thing that we would look at?
So in terms of the income and the costs, so we spoke at length about the performance of the building and what it would potentially return. Now, that is a very broad conversation depending on the occupancy type. So a couple of things that fell into that conversation really is, these are student lets. So student let is a very specific market. The area has a very big university presence. So your assumption would be that this is, student let makes perfect sense. Now, with that brings its own challenges, because you have to get that occupied every year. So it's not like a normal AST or a normal tenant who, once they're in, they typically will last 2, 3, 4, 5 years, or whatever it may be. You know that every summer you need to go back out and you need to go and find another set of tenants for another 11 months, and so on and so forth. So dare I say, it's more akin to more of a serviced accommodation type model, because you are going to have a turnover of tenants on that. Now, and that's fine as long as you factor that into your consideration on where it is. So you can't just apply yield that you would normally apply to a normal residential property because of the operating nature of running a student-let accommodation. So that was something that we had to factor in, and that was something we had to get behind and really understand what does the market actually look like in the area, rather than our assumption that because it's got a big old university that it's going to get fully let and we're going to have those, we're going to be the beneficiary of that. Another consideration that we had, and we'll unpick all of these one at a time, is what if we can't get it let? What is the occupancy that we can afford to tolerate? And if it ceases to work, what is a get out of jail card if we can't get it let to a level that it works at? So we've been exploring the ability to convert that back to standard accommodation. So not because we want to get out of the student-let market, but what's our plan B? Because you obviously, when you're in property, you're not in for 12 months, you're in it for long term. So, what is the ability for us to convert that back? But that also presents a separate risk because then there's a planning conversation that has to go on with that as well. So in addition to that, our third play was what were the LHA rates in the area? So the Local Housing Authority rates, what were they? And if we couldn't get it let to private tenants, then our third strategy would have been that we fall back to would a local housing authority take it on, and then what rates would they pay with it as well. So all of that consideration was a plan A, a plan B, and a plan C, was how can we manage this? Because you've gone and bought 24 inverted comma flats, and if there's a lack of demand in the area, then you've got 24 headaches that all need solving rather than just having one or two. And the numbers obviously get quite large at this end of the conversation. So those are the bits that we started to unpack. A lot of considerations in each of those three containers, if you like, three of those different strategies. And that's something we talked about at length and what was viable and not viable going forward.
Yeah, absolutely. And I think this is where we kind of start going, what's, a pound's a pound, of course, but what's the value of the pound in essence, isn't it? It's like, well, the quality of that pound is dependent on like anything, like a credit rating almost. It's ABC, AAA rating and all this. You see this news around banks and countries and the top rated firms, and we have this on an individual basis. Yeah, my Experian is 999 or whatever, and you've got somebody else which is 400. Well, the quality of their pound is quite different, isn't it? Yes, they are due to pay you that pound, but how able are they to pay you that pound? And therefore we start looking at, this is where the demand comes into it, the strength of the covenant on the commercial elements. And so do you want to just kind of give us a bit of a rundown as to the thought process in regards to how we assess those separate income streams?
Yeah, absolutely. So each of them have different gross revenue figures. However, each of them also have different operating costs. So the student let play on it, which is what the planning actually is. So that is our plan A, as it were. The gross income was actually reporting as the higher. So if we simply did a calculation on, student let gross income at 100% occupancy as well, occupancy is a big consideration. That on the face of it was the most attractive. However, that also has the most operating costs. The reason being is bills are included in student lets. So we had to keep an eye on utilities and the various operating costs of operating the building and the communal spaces and everything that comes along with that. We looked at maintenance, and to be fair, maintenance probably sits the same across across that and residential. To be fair, we allocated around 5% per annum spend on just maintenance of the building as a whole. And then what that meant was our net position was quite different across this. The reason being is when you deduct the bills and the maintenance from the gross income, that is substantially lighter on the student let. So that meant we had a net income coming in of around 123,000, and we started with 164. If we went down the residential route, the gross income was around 158,000. There's no bills to pay there because they're all uniquely look after their own bills, and that meant that the net income on that was about 150. Then the LHA rate, which is the lowest of them all, when you look at the gross revenue, then you've got no maintenance issues and you've got no bills to consider or anything like that. And that actually came out at about 150 as well. So the net figures that you get. So you talk about which pound is worth the most. Well, it depends how many deductions you're going to make from that pound as to what that's actually going to look like. So plan B and plan C were actually more attractive than plan A, despite the top number being the highest.
One of the things that is a bit of a challenge when you're looking for opportunities is that estate agents are very clever in the way they market properties. They will take the gross figures and then give you property is fantastic income. It gives you this figure and that jumps out of the page. But anyone who's done serviced accommodation, holiday lets, HMOs, know that that's a gross figure. And this is to your point, isn't it? Student lets the same. You are getting the top level figure, but that's not what you keep. It's the turnover is vanity, profit is sanity, right? So you'd rather take a lower gross figure, but keep a higher amount of that gross figure. And so that's the exercise is going through these to see which one of those brings out the best return, and how then do you make the numbers work based on the strategy, based on the planning permission, based on the management, operating costs, etc. So there's a number of factors, and you can say, well, I can tweak that. Great. What can I do to tweak that? Well, I can't do anything. Right, that can't move. And then you just kind of go through the separate layers.
Yeah, definitely. And then the other thing as well is, which we kind of skirted over, but it was pertinent in the last deal that we broke down as well, was does each of these flats have their own individual utilities? If they don't, then it's particularly hard to then control and police and give out the utilities and so on and so forth. As it transpires, this one does. So the three strategies that we discussed all made sense. If they were shared utilities, that would probably completely change the landscape, because we'd probably have to put the bills back in for the private tenants as well, and so on. So luckily for us, that wasn't an issue with this one, but it's still something to bear in mind. And it's interesting when we speak to clients actually about multi-unit blocks, that rarely gets asked. It's now one of our default questions: has it got separate utilities? And very often people go, I don't know. Didn't realize that was something we need to think about. So if you're doing multi-unit blocks, that needs to be almost one of your first questions on the per unit.
And also, we've even had these conversations with agents, and we ask that question, and they go, "Oh yeah, I think so," or is that I think, or I know? Oh yeah, I assume that's happened. Well, I'm sorry, but assuming doesn't work anymore, because we're the ones that'll end up with egg on our faces when we go down a finance application with the client, and we've applied for something and the client wasn't aware that it was shared utilities, and then they're left, like I said, they've paid some fees, and obviously we try and through experience make sure that we cover as many things off as possible. We're never going to cover everything off. We just want to make sure that we cover as many of those things off to get it right first time when it comes to an application.
Yeah, definitely. So once we've sort of laid out the varying different strategy, the plan A, B, and C that we've got, then the next question was ultimately around occupancy. So you've got 24 units, 100% occupancy is ideal, but that is still 24 different tenancy arrangements of some description that you will ultimately need to deal with. Obviously, if that went down the LHA route, the Local Housing Association, then that is a slightly different conversation, because that's their problem. But then you take arguably a lower rent for that, and we've worked that out and so on and so forth. So, but your risk profile is a bit different. So when we look at whether it be private tenants or student let, there's still an occupancy play, an occupancy consideration, I should say. Now, the occupancy consideration is probably, is more volatile in the student let. As mentioned, we know that goes to zero occupancy every year, and then you've got to fill it back up. Whereas on private tenants, you won't go to zero every year. You'll always have some level of occupancy that maintains, and you'll just be losing a handful, or there'll be some turnover, and I have no doubt, within them 24 units. So what we had to then do is to work out what level of occupancy can we tolerate before it becomes a problem.
Absolutely. So we've looked at the student element, both the figures, the costs, and the demand. and what kind of occupancy we can expect, and our plans B and C. What about the commercial aspect?
So the commercial arguably is a bit easier. So commercial presents its own separate set of risks, which we've gone over in the past. This, however, had a couple of pros and cons. The main attraction, as I mentioned, was a flagship tenant. They were in on a 25-year lease, I think it was, or something like that. So it was a fairly substantial term lease. They were not going anywhere, given the location that they were in and the type of business they were. It's not easy for them to lift and shift into another location. And it was prime for where they've actually located themselves. So we were confident that when their break clauses come up, that they weren't going to be exercised anytime soon. The rent arrangement was upwards only rent on the business premises, and that was index linked, I believe, from memory. So that was something that was relatively attractive to us going forward. And given the quality of the tenant, we knew that they would look after the premises, given what they actually do as a business. So that one was attractive, ticked all the boxes. We didn't have to spend too long looking at that one. That sort of answered its own questions. The other occupant is a little bit different on the basis that they had paid their rent up till now. It was let out. They had never actually occupied the premises. So I think they'd taken it because, again, these properties don't come up very often. It was a food outlet. So they obviously took it on the assumption either to protect their existing business or to one day occupy. The main thing for us, though, was the break clause was due up in the next 12 months. And on the basis they'd never occupied it, that really did feel like they were going to exercise that right to exit. Now, we hadn't spoken to them. We hadn't understood their intent. But there's a big red flag there that that income was going to get lost. And it was not an insignificant amount of income, which would have effectively put more pressure on the occupancy rate of the upstairs going forward. So, again, these are dynamics that you think you squeeze one end of the balloon and the other part inflates, and you squeeze that end and the other part inflates, so you're just moving the problem around because you still ultimately need to service a level of debt or interest at a set level. So you want to understand where's that money actually coming from, and at what risk are we of not having that income to subsequently get the outcome that we want.
Yeah, absolutely. So once we've considered all of those and the likelihood of what the likely rent will be, the likelihood of that rent being paid, the likelihood of that rent continuing at that level over a period of years. As I said, it's not just a short-term purchase, it's a long-term purchase, an investment. And then we start then to work backwards and look at what are those gross yields, what's the net income, what's the net yield, what are the finance costs we're likely to pay on it, what cash flow does that allow, and then what is our cash on cash return. And all of those metrics, there's one probably that we kind of use as a North Star, but there's not one. They all feed into each other and they're all just as important. So we go through that process then, obviously spreadsheet that out and understand the tweaks that we can make, the tweaks we can't make, the stress tests and everything else. So trying to understand, and then ultimately it's like, is this property worth the hassle, worth the risk, worth the money, and is that return worth it? Because I've kind of used this example before, if you had a deal that was giving you 10 grand a month net income, is it a good deal? And I say, yeah, okay, great. Well, it's a 20 million investment to get a 10 grand return. It's probably not that good a deal because the tolerances are very minimal as a percentage. And so it's easy to get kind of caught in by one number. But actually the reality is, well, what do I need to put in to get that return out? And so you can't just use one, you've got to use a number of different metrics to break into that risk.
And we did this as well. Interestingly, we speak to a lot of clients who, and this is so typical for HMOs, is I value the property by just taking a rental income and taking a 10% yield over the top. So I've times it by 10 to get our purchase price. Well, that is fine as a guide, but you need to put a bit of thought into it. So in this particular example, because of the volatility that exists in the student-let side of the business, side of the property, we applied a slightly different metric, so a higher yielding metric. Now, for those that don't quite understand how yields work, the higher the yield, the lower the value of the property becomes. Okay, so, and the lower the yield, the higher the value is. Okay, so we applied a slightly higher yield to the student let element of the property, the 24 units. To the covenant that was particularly strong and was in there for 30 years or 25 years, we applied quite an aggressive covenant to that because we wanted we want to acknowledge the value of that tenant. And then for the property that was vacant and we run a real high risk of that not being occupied in 12 months' time, we applied a slightly higher yield to that, better than the residential, because commercial usually commands a slightly better yield, but certainly not as attractive as the yield that was attributed to the other tenant. That meant that we had a blended yield figure that we could apply across, and that's how we derived what our own value of the property was. And that might be different to our valuers. We're not valuers, but this is what we could justify in our own minds that we could attribute to it. And that then fed us back what the actual value was going to be. And that effectively formed our offer price.
Yeah. And, ultimately, once we've taken all of these considerations into account, probably just the one kind of element that we haven't really discussed before we go into the offer price and what that looks like is just around, we've talked about the lease, the commercial leases, we've talked about the HMOs and things. One thing that probably people don't consider too much either is, we talk about refurb, but it's around compliance and the property itself. So we've talked about the HMO element, the student element being its planning permission is for student lets only. It's not a C3, so we couldn't just put residential tenants in there. So that's a restriction from a compliance perspective. We couldn't, if the student market dropped, we could not just change it to C3. That brings with it the planning issue to change the use. So it's a material change of use. So it's a planning application. And therefore, when you switch from one to another, from a class perspective, then that triggers up-to-date building regulations, up-to-date sort of fire assessment, even though a commercial building should have its own fire regulations. But then fire risk assessment, making sure all the fire doors, alarms, escape routes are in place, electrical certificates, gas safeties. Obviously, with commercial, you have to have asbestos management in place. So there's a number of things that you have to consider more on the the main ones being the fire element, fire risk assessments, asbestos. Those are the two kind of main ones that people look at or lenders and solicitors will want to see, but they do not usually ask for those until the back end of and obviously if you're buying a commercial property or semi-commercial property or anything where there's any element of commercial, you need to see the fire risk assessment. So if you are buying an existing building, one of the first questions you should be asking, and we had a client that did this and we insisted that they do it, and the vendor basically walked away. And the reason the vendor walked away was because they'd never done a fire risk assessment. And they knew one, there's a cost of getting the fire risk assessment done, but they knew deep down that building wasn't that well set up from a fire risk assessment perspective. And there would be a lot of works that would need to be carried out to bring it up to the correct fire standards. And therefore, that is an issue. So, and that comes at a cost, which from a buyer's perspective, you want to get that priced into the purchase price, which lowers the purchase price, and which is why the vendor kind of disappeared. And so you can look at that and go, well, I've missed out on that property now. Have you missed out on the property, or have you avoided a costly purchase? That's the way we would look at it. So just how many of these things can we iron out before we get to the point of agreeing a purchase?
Yeah. No, I agree.
So just wanted to kind of touch on those points. So from a finance perspective then, are there any things that we kind of haven't touched on if we were looking to finance this?
So if you're looking to finance this, there are a few things actually, which it comes back to a little bit. Just because you could doesn't mean you should. Okay, so if you took this deal to a mortgage provider, 24 unit student let, good, strong covenant on the ground floor, not so strong on the other floor, but that's fine. You can still rely on that income, despite there being a break coming up. What you would pretty much do, you would look at, this is the monthly income. So you would take the 11 months you take the 11 months income, divide by 11, multiply by 12, will give you the annual income. You would do that across 24 units. That would be your gross income. They would allow for a deduction of certain costs, let's say 20%. Depends on what the valuer says at this point. So they will deduct their costs. You also have the income on the commercial, on the ground floor, etc. Now, many lenders with a building of this nature will lend 70, maybe even 75% loan to value on it. And the income levels that we've discussed would service a loan of that amount on an interest-only basis. So on paper, the mortgage lender, assuming the valuer doesn't make any negative comments around demand, okay, so we assume the valuer likes it as well, then the lender will effectively lend based on all that income. And that's great if you want a mortgage. Not so great when you've got to pay for the mortgage, which is if you then fall down to 50% occupancy and so on, you've leveraged that property off the strength of 100% occupancy. However, you're now only experiencing 50% occupancy. You can see now all of a sudden you can get yourself into a bit of bother around servicing the monthly loan payments and so on. So, and this is where it comes to, just because you can doesn't mean you should. Just because you can get a mortgage at 75% loan to value, etc., doesn't necessarily mean that that is a great thing to do. Now, you'd like to think that the process of underwriting will probably identify some of these risks and you'll have to answer them and so on. So don't be taken aback if you get grilled over your numbers, because as a third party who's unemotionally attached to this transaction, as an underwriter who's looking out for the bank's interest and not yours, they're going to test this because of what I've just discussed around it being, well, actually, what if it isn't fully occupied? What's this going to happen? What's your plan B? This effectively needs to be looked at as more of a business than it does as a property. It just happens to be involved in property. There is a whole trading element to this around how you manage and keep it occupied. So yeah, those are the considerations. And then also, if you're stepping into a property of this nature and you don't have the requisite experience behind you, you're going to have to use a managing agent. You can't manage this one yourself and those sorts of things. So that's what a lender's really going to be digging into before they'll agree to sign this off in terms of lending against it.
Yeah, absolutely. So all of the other standard stuff, underwriting, valuations, affordability and debt service, and like you said, borrower experience. Have you got experience within the commercial space and do you understand how it works, and your ability, your background, assets and liabilities to see what strength you've got if things go wrong. So yeah, all good stuff. So we've done all of that. We've stress tested it. We've looked at the various things, and then we just get to the point then where we kind of have to make a judgment call or an offer. Now, one of the golden rules of property investing is that whatever you spend time on analysing a deal and going through this level of due diligence, is that you make an offer regardless. Now, yes, you might get to the point where you think, I can't offer that, it's too cheeky. Whereas there's some school of thoughts, well, if you're not embarrassed by your offer, it's not low enough. So there's a number of old sayings that work in the game. But ultimately, if you offer 100 properties and they're all embarrassing, there's a chance that one of those might come through. And that's all you need, is to get one of those deals through. And it is difficult. And we're not trying to, and we try and manage the expectation of the agent and things, because we're not trying to squeeze deals for the sake of squeezing deals. We're not doing that by any stretch. We're just trying to make deals that work for us based on our circumstances and our numbers. And we're very clear on how we've come to that valuation and offer price. And we kind of just say, look, this is what we do based on the risk, all of the due diligence. These are the issues that we see, and therefore this is our offer price. And sometimes they'll just say, oh, thanks, but no thanks. Other times they'll say, you're not far off, you need to come to this level. Or it's we'll consider it and leave it on the market. It depends how long it's been on the market. If it's just come on the market, then they'll probably say, well, thanks, but we're going to explore some advertising time and see how long it goes on for. Other times they say, well, it's been on for 2 years. They weren't that motivated before, but actually now they are becoming a bit more motivated to sell and maybe we can have a conversation and see where we can get to. So you never know, and people's circumstances change all the time. And a lot of the properties that we're looking at in the kind of a little bit more expensive like this, a lot of the time they're owned by funds and pension funds and different REITs and various things. And it may just mean that they've had to have a rebalancing of their portfolio and they just need it gone. And they've had their return out of it. And so the capital element is less important, and they just need it because they've breaking by holding so many properties, and the weighting of their rate or their pension fund has gone too far in one direction. They need to reassess that, the mix of their investments, and they have to, because of the legal obligations, rebalance their portfolio, in which case they just need the property gone, and it doesn't really matter what they get for it, because the penalties elsewhere are far greater than taking a reduction on this capital value on this property. So you just never know what the circumstance is. So all you can do is just keep making your offers and see what happens.
Yeah, definitely. And we made our offer. It wasn't where, it wasn't the 2.5 million they were looking for. It was notably less. But that was based on us doing our own due diligence. We'd run the numbers, we'd understood the risks. And we didn't just throw a number over in an email either. We substantiated why we came out to the number we came out. So to show them that we put some thought behind it, that we hadn't just picked an arbitrary number and tried to, as you say, nick a deal type thing. And I think that goes a long way as well, just to be professional in the way that you offer on properties, to follow through. They came back, they presented to the client. Client refused it, asked if you would be able to come up a bit. I think those are the words. And then when we said, well, can you let us if anything else materially that we've missed that would justify paying more? And also what sort of figure are they wanting us to get to? And the response was 2.5 million. And it was like, well, why are you going to ask that question? Because we're that far away. So that was a bit interesting. But yeah, how you present your offer is just as important as the offer you present, as the offer you make. Because despite we may not proceed with this one, or we may do in the future, we don't know. We still want that relationship with the agent. They're a well-known agent. They've got good opportunities. They're well established. We don't want to appear to come across as time wasters and tie kickers, and they're constantly just analysing deals and making lowball offers. So I do think that's really, really important to try and maintain that relationship with the agent. They understand we're trying to make something work, and they're ultimately trying to get as much as they can for the seller.
Yeah, so yeah, absolutely. I think, it's important to kind of go through, don't just take those headline numbers, because just closing up really is that hopefully you've had some opportunity to consider some of the things that we use from an analysis perspective on how we come up with the numbers and just digging into the detail. And a good deal isn't one that only works when every unit is full. It's one that remains manageable when things change, and inevitably things do change. So it's just making sure what is your lowest, as you mentioned earlier, what is the lowest occupancy that we can tolerate here to break even, and then kind of digging into the detail around that and demand and everything else. So yeah, thanks for that, Mark. It's really useful. And obviously, if anyone has any questions on any of these types of deals they'd like to kind of swing by us, then please by all means do so. Anything else from you to finish off?
No, nothing at all. I think we've pulled that one apart, and hopefully the listeners found it useful.
Awesome. Thanks for your time, Mark.
Cheers. Take care.
Hopefully you enjoyed that episode, and this case study would show why complex property investment cannot be assessed through the headline figures alone. The Building Society covenant may strengthen the commercial income, but the lease terms still matter. 24 student rooms may produce an attractive rent, but if the occupancy isn't there, the management costs are high, and the compliance needs more updating, then you need to decide whether that's genuinely sustainable or not. And from a finance perspective, it's not enough to ask how much somebody can borrow. We need to understand which lender will recognise the income, how it's valued, whether the borrower can manage it, and what happens when the conditions are less favourable. A complex property is not automatically a bad property, but the more moving parts the deal has, the more detail and analysis should be. And hopefully we're helping you on your journey to buy good long-term investment properties and assets, and supporting you with that long-term income and wealth creation that you desire. So hopefully that's been a good episode. If you like it, please like and share it with anyone that might be interested in this type of property. If you've got a deal, by all means, reach out to us at Prime Property Finance to have a chat with you about one. And in the meantime, thanks for listening, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.